Okay, picture this. It's late February 2026. A tension that's been simmering for years in the Middle East just explodes. And in just 72 hours, the entire global financial market gets completely turned on its head. Today, we're going to break down how a war in Iran could set off a crazy chain reaction, hitting everything from stocks and bonds to the interest rates that you deal with every single day. Right, let's get into it. To really get the global impact, you have to understand this one tiny spot on the map. This is the Strait of Hormuz. Now, it doesn't look like much, but it is, without a doubt, the planet's most important energy choke point. Think about it. More than a fifth of the entire world's oil supply has to squeeze through this narrow channel. It's basically the main artery of the global economy, and it's ground zero for this whole crisis.
So the big question is, how did a regional spark manage to ignite a global economic firestorm? Well, the truth is, the escalation from just simmering tensions to all-out conflict happened incredibly fast. Let's just walk through the first few hours of how this whole thing could kick off.
It starts on February 28th. Coordinated strikes hit key Iranian targets. The response, it was immediate and it was chaotic. Over the next couple of days, Iran hits back, striking oil tankers in the strait and firing missiles at neighboring countries. The fight widens really fast, pulling in other players, and by March 3rd, the U.S. is already signaling, hey, this isn't going to be over quickly. They start evacuations and offer insurance to tankers brave enough to make the trip. The crisis was officially on. You know, this didn't come as a complete surprise to the financial markets. Take a look at this chart. It's the stock price for Frontline, a huge oil tanker operator. See how the price starts to spike before the fighting even officially starts? That's because traders were already betting on disruption. They figured ships would be forced to take longer, more expensive routes. In a way, Wall Street was pricing in a war before the first shots were even fired. And that brings us to the real heart of this whole thing. How does a war in one part of the world cause such massive, immediate chaos everywhere else? Well, it's not random. It's actually a pretty predictable process. Kind of like a geopolitical chain reaction, where one domino just knocks over the next, and then the next, and so on. It's a totally fair question, right? You're seeing all this stuff unfold on the news halfway across the world, and you're thinking, okay, but why does this matter to my 401k, or my savings, or even the price I'm paying at the pump? Well, let's connect those dots. This slide lays out that chain reaction perfectly. Let's just walk through it. It all kicks off with oil disruption. That choke point gets blocked, and boom, oil prices spike. That spike leads straight to higher inflation because, let's face it, energy costs are baked into almost everything we buy. Then, central banks like the Fed have to react. They get way less likely to cut interest rates because that would just pour fuel on the inflation fire. That decision makes the bond markets get weird. New government bonds have to offer rising yields, basically higher returns, just to be worth buying in an inflationary world. And because of that, older bonds with lower yields suddenly look pretty unattractive, so their prices fall. Finally, all of this puts a ton of pressure on stocks. Companies are getting squeezed by higher energy costs and higher borrowing costs, which eats into their profits and naturally freaks out investors. It's a 6-step cascade, right from the battlefield to your bank account. And here's what that looks like in the real world. On the left, you've got a chart of oil prices just shooting for the moon because of the conflict. And on the right, the stock market is feeling all of that downward pressure. It's a classic seesaw relationship. As the risk and cost of oil goes up, overall market confidence tends to go down. This is the domino effect made visible. Okay, so we get the mechanics of how this all works. But what happens next? Where does this crisis actually go? The analysis really breaks it down into 3 possible scenarios. And believe me, each one has a totally different impact on the markets. First up, the best case scenario, which is also unfortunately seen as the least likely, a quick resolution. We're talking about a ceasefire happening within a few weeks and the whole crisis just rapidly de-escalating. If this were to happen, you'd hear a massive collective sigh of relief from the markets. Inflation fears would just vanish, kicking off a huge relief rally in stocks. Bond yields would drop like a rock and their prices would shoot up. It's a great outcome, but again, not the one that experts are betting on. All right, next up is scenario 2, what they're calling the muddy middle. And this is seen as the most likely outcome. It's where the conflict doesn't actually end, but it also doesn't totally spiral out of control. It just kind of hangs there in a state of high tension. The market reaction to this? pure uncertainty. Inflation stays sticky. It doesn't go away, but it's not blowing up either. Stocks get super choppy and volatile, jumping up and down with every single headline. And bonds and their yields, they pretty much just tread water. This is a market that's just nervous, with no clear direction at all.
And that brings us to the most pessimistic scenario. The war just drags on for months and months. The conflict gets worse, it spreads, and it keeps choking off that critical flow of oil. In this scenario, that whole financial chain reaction we talked about goes into overdrive. Inflation starts to accelerate. That triggers a massive sell-off in stocks as company profits get hammered. Yields climb higher and higher, and bond prices just keep on dropping. This is the scenario that could really tip the global economy into a serious downturn. So with these three very different futures all on the table, what's the bottom line? What should we be paying attention to right now to figure out which path we're actually on? This quote from the analysis just nails it. In a matter of days, this conflict completely rewrote the economic story for 2026. Everybody was expecting central banks to start cutting interest rates. But that narrative got thrown out the window, replaced by the fear that rates might have to stay higher for longer to fight off a new wave of inflation. And if you want to know which scenario is playing out in real time, these are the three things to watch. First, global oil prices. Are they calming down or are they still climbing? Second, the actual number of ships getting through the strait. Is oil flowing or is it stopped? And third, what's happening on the ground militarily? Is the conflict being contained or is it spreading? These are the clues to our economic future. And that really brings us to our final thought. This whole thing is just a massive reminder of how ridiculously interconnected our world is. A conflict in one little waterway can send shockwaves through every market, every portfolio, and eventually every household budget. It leaves us with a really big question to think about. In an economy this global, is any conflict ever really local?